If you've ever owned a stock and seen a small cash deposit hit your account out of nowhere, that was a dividend. By the end of this video, you'll know exactly how dividends work, the 4 dates every dividend follows, and how to keep the IRS from taking too big a slice. In 2025, US companies paid out around $700 billion in dividends. That's $700 billion handed back to shareholders just for owning stock. But here's the catch. The average S&P 500 yield is only about 1.3% per year. Dividends are smaller than most beginners expect, and the tax rules around them matter more than most videos let on. So what is a dividend exactly? A dividend is a cash payment a company sends directly to its shareholders, taken from the company's profits. The board of directors decides whether to pay one, how much it'll be, and how often. Most US dividend-paying companies pay every 3 months. That's why you'll hear the word quarterly a lot. Dividends are completely optional. A company can start them, stop them, raise them, or cut them at any time. And not every stock pays one. Many of the biggest growth companies, like Amazon and Tesla, choose to reinvest profits instead. Here's the part most beginner videos rush through. Every dividend follows 4 key dates, and missing one of them matters. First, the declaration date, when the company's board officially announces the dividend amount and the upcoming schedule. Second, the ex-dividend date, the most important one. To qualify for the upcoming payout, you have to own the stock before this day. Buy on or after, and you wait until the next quarter. Third, the record date, usually 1 business day after ex-dividend. The company freezes the official list of shareholders. And fourth, the payment date, typically about 30 days later, when the cash actually lands in your brokerage account. The ex-dividend date is the one to remember. This is where it gets interesting, and where most beginners pay too much in taxes. The IRS splits dividends into 2 buckets. Qualified dividends are taxed at the long-term capital gains rate. That's 0, 15, or 20%, depending on your income. Most regular US stocks pay qualified dividends, as long as you hold the shares for at least 60 days around the ex-dividend date. Ordinary dividends are taxed at your regular income tax rate, anywhere from 10 to 37%. REITs, MLPs, and most bond fund payouts are ordinary, no matter how long you hold them. On $1,000 of dividend income, qualified means a tax bill of $0 to $200. Ordinary can be $370, same income, very different outcome. Let's make this concrete with real numbers. $10,000 in an S&P 500 index fund. At a 1.3% yield, that's about $130 in dividends per year. Same $10,000 in SCHD, a popular dividend-focused ETF, yielding around 3.7%. Annual dividends, about $370, almost 3 times more income. But here's the trade-off. SCHD has historically grown slower than the S&P 500. You're trading total return for current cash flow. That's the dividend investor's choice in one number. So when do dividends actually matter? 4 scenarios. 1. Retirement income. Predictable cash flow without selling shares is what most retirees actually want. 2. Compounding through DRIP, the dividend reinvestment plan. Every payout buys you more shares, which pay more dividends. 3. A maturity signal. Companies that pay growing dividends for decades, like Coca-Cola or Procter & Gamble, are signaling stable cash flow and disciplined management. And 4. The total return mindset. Dividends aren't extra money. They're part of your total return. A stock paying 3% in dividends but only growing 2% has the same total return as a stock with no dividend growing 5%. 3 myths to bust before you go. Myth 1. Higher yield always means a better stock. False. Yield is the dividend divided by the share price. When a stock crashes, the yield spikes. A 10% yield often means the market expects a dividend cut. Always check why the yield is high. Myth 2. Dividends are free money. Also false. On the ex-dividend date, the share price typically drops by roughly the dividend amount. You don't get richer just because cash showed up. The value just moved from your share price to your account. And myth 3. Always reinvest dividends. It depends. In a Roth IRA or 401k, sure, reinvest automatically. In a taxable account, you might want the cash to rebalance, pay taxes, or buy something better. There's no one-size-fits-all answer. Dividends are profit sharing for shareholders, real money, but smaller and more tax-sensitive than most beginners think. Hold quality stocks the right way to get the qualified rate, watch out for yield traps, and remember, total return is what builds wealth, not just dividend income.